Joining me now is Joel Shulman, founder of ERShares, and Chad Morganlander, portfolio manager at Washington Crossing Advisors. This pullback was pretty notable from the New York Fed saying, hey, don't read into it. But then we saw comments from Clarida as well on Fox, basically echoing what we'd heard from Williams. How do you read into this? Is Citi right to already say, hey, we're changing our Fed call? We think it could be 50 basis points.
Yeah, I mean, for a while, we've been looking at 25 to 50 basis points. I mean, as you know, a few weeks ago, they priced in 100% likelihood of a 25 rate cut. 50 basis points is certainly on the horizon. And there was hint at the last discussions that a couple of the members of the Fed were at least discussing about doing a little bit more. I mean, we've got to remember this is the strongest June, July we've had since 1955 for the S&P, the strongest we've had for the Dow since 1938. So we've already benefited quite a bit for the markets this summer.
All right, Chad, when we're looking at what the expectation is here, after Clarida spoke, we saw that Fed funds rate jump to 69% expectation for a 50 basis point cut. How do you read this? Where are you putting your money in terms of this Fed cut?
So we're believers that they'll go only 25 basis points based on the fact that you have virtually full employment. Inflation trends look to be improving modestly, at least in the short run. And then global growth and global financial stress doesn't look all that high.
So those comments yesterday did not change your expectations?
I would absolutely look past those comments, and I would bet that potentially that by the end of the year, they go another quarter of a point. It's all based off of trade-related issues as well as global growth issues outside of the United States at this point.
All right, so when we're talking about trade and global outlook, next week we're getting some earnings reports from some of the biggest names with international exposure. We're looking for Boeing, for Caterpillar, for Amazon. I mean, especially these FANG names, right? The FA, what puts the FA in FANG. How are you assessing the impact of this continued standoff and tensions with China, Joel?
Well, so traditionally the FANG stocks are very entrepreneurial companies, and these entrepreneurial companies adapt very quickly to changes in the marketplace. Now, we saw a hiccup yesterday with Netflix, if you want to use maybe a different adjective, and clearly their international growth is part of the drop that they had. But when we look at the exposure to Amazon and some of the others, I mean, when we think about these companies, they're spending lots of money. They're spending 20, 30, 40% increases in R&D. They're able to pivot very quickly, and they also have concentrated ownership, so the leaders of the companies can move it. So I think we're going to see some mixed results. I mean, certainly with Boeing and a few of the others, we already anticipate some negativity. And I think what I do when I look at these large cap stocks is I break them down into the traditional sort of more bureaucratic companies that move very slowly versus the younger companies, which tend to be the FANGs that pivot very quickly. And we're, I think this is going to be a very interesting, summer. We saw yesterday Microsoft went up, and we saw Netflix went down.
Chad?
Yeah, from our perspective, you now have the market overall when it comes to earnings bifurcated. You have large cap tech names that have been moving the revenue line for the S&P 500 estimates quite higher at roughly about a 10%, like Microsoft. But then you have the industrials that are taking the impact of the slowing of global trade and global growth. So industrial earnings should be somewhat more muted at this point in the earnings cycle.
Let's talk a little bit about oil. We're seeing oil move higher this morning on news that the U.S. Navy has downed an Iranian drone. We got news yesterday that Iran had captured what it called a smuggler ship, an oil tanker that said was smuggling oil. How much are you looking at the geopolitical impact of what happens with an Iran deal and the potential that European leaders won't be able to work out a deal?
Back in the 1970s, this type of news would have been catastrophic for oil prices. I mean, we would have seen them jump, 10, 20, 30% on fears of war in the Middle East. With fracking now positioning the U.S. as the largest producer, we've been benefited quite a bit from this news. And this is one of the reasons why, despite some of the rumblings in the Middle East over the last month or two, we've still seen oil drop in price, and energy is the one sector that's not yet recovered year to date. So I see continued movement in this direction. Maybe there'll be some modest rises, but the fracking has really insulated the U.S.
Short term and long term. In the short term, yes, you're going to get headline risk that's going to make the oil market fluctuate in a violent manner. But in the long run, we're believers that you're going to continue to see deceleration of global growth, i.e. China, EM, that's going to adjust the demand curve lower, having a major impact on oil prices and commodity prices over the next 3 to 5 years.
Chad, Joel, thank you, gentlemen, both for joining me so early this morning. Appreciate that.
Thanks.